Let's talk about a topic that gives all investors a headache: the Federal Reserve's interest rate policy. Every once in a while, the eyes of the world will focus on a building in Washington, waiting for several economists to make a decision on a number. This number, the federal funds rate, is like an invisible hand, stroking every nerve of the global capital market. So, the media, analysts, and traders will take out magnifying glasses, analyze the post-meeting statement word by word, and obsessively interpret a chart full of mysterious dots, trying to peek into it and predict the exact time of the next rate hike or cut. But this may be a carefully staged but meaningless drama. A point that may surprise you is that for a rational investor, trying to accurately predict the next move of the Federal Reserve, or even the next move, is almost a futile effort. This obsession is particularly reflected in the fanatical interpretation of the so-called dot plot, which is precisely Wall Street's favorite but most misguided game. The truly valuable insights may not be hidden in the obscure words of the Fed chairman or the complex models of economists, but come from our daily experience as ordinary consumers and our understanding of basic human nature. The signals sent by the Fed are of course important references, but the vast amount of analysis and second-hand interpretations generated around it can mostly be regarded as market noise. Today, we will take the perspective of Nick Timiraos, a senior reporter of the Wall Street Journal and known as the Federal Reserve's mouthpiece, as a benchmark, and combine multiple reports to explore in depth why predicting the Federal Reserve is a metaphysics and how, as a pragmatic investor, we should penetrate the layers of fog and see the truth of the economy. On June 18, 2025, the Federal Reserve made another, unchanged, decision as expected. According to reports from multiple media outlets such as the BBC and the Wall Street Journal, the Federal Open Market Committee, FOMC, maintained the target range of the federal funds rate at 4.25% to 4.5% for the fourth consecutive time. This decision itself was within the general expectations of the market. However, under the calm surface, undercurrents are surging. At the press conference after the meeting, Federal Reserve Chairman Jerome Powell repeatedly emphasized one word: uncertainty. He admitted that the uncertainty of the current economic outlook is abnormally high. This is not diplomatic rhetoric, but the most real feeling of decision-makers. They are like the helmsman of a giant ship, sailing in an unprecedented fog. No matter which direction they turn the steering wheel, they face the following huge risks. Risk 1, tariffs, the elephant in the room. Most people believe that the biggest source of this fog comes from the Trump administration's radical tariff policy. According to the Wall Street Journal, since Trump announced large-scale Liberation Day tariffs on April 2, U.S. tariff rates have soared to the highest level since the 1930s. Tariff policy is an extremely difficult problem for the Federal Reserve. It is like a supply-side shock that directly pushes up the import costs of companies. In theory, companies will pass these costs on to consumers, thereby pushing up inflation. Powell also admitted this at the press conference, saying, "Everyone I know is predicting that inflation will rise meaningfully in the coming months because of tariffs, because someone has to pay for them." He further disassembled the problem: it could be manufacturers, it could be exporters, it could be importers, it could be retailers and consumers. Each of them will try not to be the one to pay the bill, but in the end they will share the burden, or one party will bear it all. The subtext of this remark is that even the Federal Reserve itself is unclear about who will ultimately bear the cost and how quickly it will be transmitted. Powell frankly stated that predicting this process is very difficult. If the Federal Reserve raises interest rates too early because it expects tariffs to push up inflation, it may stifle economic growth, but if they underestimate the stickiness of inflation and wait until inflation gets out of control before taking action, they will be passive. Risk 2, the looming ghost of stagflation. Another terrible prospect brought about by tariff policies is stagflation, a situation where economic growth stagnation and high inflation coexist. According to the New York Times, although Powell never publicly mentioned this word at the press conference, it was undoubtedly one of the most important topics in the meeting. The Fed's own economic forecasts also paint a picture of stagflation. They expect economic growth to slow sharply this year to 1.4%, down from the 1.7% forecast in March, while the unemployment rate will rise to 4.5%. At the same time, core inflation expectations have been raised from 2.8% to 3.1%. Slowing growth, rising unemployment, and rising inflation, this is the worst nightmare for any central bank. Because the Fed's two core goals, maximum employment and stable prices, are in conflict in this case. Usually, to fight inflation, they need to raise interest rates; to stimulate employment, they need to lower interest rates. When both problems arise at the same time, central banks cannot step on the brakes and the accelerator at the same time. As Princeton University economist and former Fed Vice Chairman Alan S. Blinder pointed out, the two severe stagflations the United States experienced in the 1970s were both related to soaring oil prices. And now, in addition to the tariff shock, the escalating conflict between Israel and Iran in the Middle East has also brought new upside risks to energy prices, which makes the situation more complicated. Risk 3, inescapable political pressure. In addition to economic uncertainty, political pressure from the White House has also made the Fed situation worse. On the day of the Fed meeting, President Trump once again mercilessly attacked Powell, calling him a foolish man, and publicly expressed his hope that the Fed would reduce interest rates by 1 to 2.5 percentage points. He even joked that perhaps he should be appointed as the chairman of the Fed. Although the Fed is legally independent, this constant political shouting will undoubtedly affect market expectations and challenge the credibility of the central bank. Some analysts believe that Trump's pressure may put him in trouble because central bank bankers tend to vigorously defend their independence and would rather wait and see unless there are extremely good reasons. It is in such a background of internal and external difficulties and fog that the Fed has chosen a wait-and-see attitude of unchanging in the face of changes. They need more time and data to judge the direction of the economy. Powell said, "We have not experienced this before, and I think we have to be humble about our predictive ability." This sentence provides the best footnote for our understanding of the dot map game in the next chapter. If you follow financial news, you must be familiar with the dot plot. Once a quarter, this chart released after the FOMC meeting will use small dots to mark the anonymous predictions of interest rates for the next few years by each official attending the meeting, including voting members and non-voting regional Fed presidents, a total of 19 people. The media and analysts will immediately calculate the median of these points and regard it as the official guidance of the Fed's future policy path. However, in Nick Timalaos's view, this obsession with the dot plot is almost a self-deceiving collective hallucination. Because the dot plot is not a commitment, it is just a snapshot of feelings of the committee members at the time. It is like a love promise between young lovers, just a spiritual portrait of that moment. First of all, we must understand the nature of the dot plot. It is not a consensus policy path reached after full discussion by the committee, nor is it a commitment to the market. It is just a collection of personalized, anonymous predictions given by 19 officials at that point in the meeting based on their respective understanding and models of the economy. Powell himself has repeatedly stressed this point, saying at a press conference, "No one holds these interest rate paths with a high degree of confidence." In other words, these dots are just a snapshot of what officials are thinking at the moment, and the positions of these dots will change as economic data changes. Nick Timalaos made a more scathing satire in his article published in the Wall Street Journal and on social media. He pointed out that in this meeting, Wall Street was obsessed with guessing whether the median forecast of 19 officials would fall on 1 or 2 rate cuts this year. However, it only takes 1 or 2 officials to change their dots for the median to change, and the entire market narrative will be reshaped. This just shows how fragile and unreliable the dot plot is. History is the best teacher. Timalaos reminded us to look back a year ago, in June 2024, when the median forecast of the dot plot was reduced from 3 rate cuts to 1. However, after that, the Fed finally implemented 4 consecutive rate cuts starting in September. He asked rhetorically, and yet here we are, a year later, analyzing these dots word for word. This is undoubtedly a great irony, proving that the value of the dot plot as a forecasting tool is extremely limited. In the latest dot plot, this inherent disagreement and uncertainty is vividly reflected. According to analysis by the Wall Street Journal and the New York Times, 7 of the 19 officials believe that there should be no more rate cuts this year, a significant increase from 4 3 months ago, while the number of people who believe that there should be at least 2 rate cuts has dropped from the previous majority to 10, and 2 others believe that there should be 1 rate cut. When Powell was asked about this huge difference of opinion, he admitted, there is a fairly healthy diversity of opinions within the committee. This diversity just shows that there is no unified view on the future. In such a situation, it is obviously a case of trying to find a sword by cutting the boat. Perhaps the most incisive comment came from Neil Kashkari, president of the Minneapolis Federal Reserve. Timaleos once quoted him as saying, "Most of the time, I really regret having to fill out this summary of economic projections, SEP, of which the dot plot is part. You can't convey how uncertain you are at all, because you have to draw these dots." This sentence reveals the biggest paradox of the dot plot. It tries to depict an inherently uncertain future with precise dots. It forces decision-makers to compress complex, multidimensional thinking into a simple, seemingly certain number, which is itself a distortion of information. In layman's terms, these numbers are all shot. For investors, instead of spending a lot of energy guessing where the median of the dot plot will fall next time, it is better to understand the profound uncertainty reflected behind the dot plot, which even Fed officials themselves cannot avoid. Recognizing the limitations of prediction is itself a higher level of wisdom. Okay, let's talk about this first. In the next issue, we will discuss the relationship between tariffs and inflation a little bit. We will continue next time.